The head of the Bank of England, Andrew Bailey, has sounded a serious alarm. Speaking from Washington on April 16, 2026, he warned of a very big energy shock heading for the United Kingdom. The source? Escalating conflict in the Middle East, especially involving Iran. For a nation like the UK, which relies on imported energy, this is a significant cause for concern. Bailey's warning signals that the economic weather is about to change. Rising oil and gas costs, driven by conflict, will soon show up in the prices we all pay. This energy shock threatens to undo progress made in controlling inflation. The Bank of England now faces tough choices that will affect mortgages, loans, and the cost of living for millions. The timing is crucial. Just as there were signs the cost of living crisis might be easing, this new flare-up brings fresh uncertainty. The key question: how high will energy prices go, and for how long? For households, this means higher bills for heating, fuel, and groceries. Businesses will pass on increased costs to consumers. Bailey's alert is a signal we're on the edge of another period of financial pressure, and the coming weeks are critical. To understand Bailey's concern, look to the Middle East, specifically the Strait of Hormuz, a vital artery for global oil. The recent conflict involving Iran has made markets nervous. Even the threat of disrupted supply sends oil and gas prices soaring. Traders bet on future shortages, driving up prices before any real disruption occurs. This risk premium is added to every barrel of oil and cubic meter of gas. History shows Middle Eastern conflicts often trigger global price shocks. The UK, heavily reliant on imports, feels these shockwaves quickly. Energy companies pay more for raw materials and pass those costs down the supply chain. Higher wholesale prices hit refineries, power plants, petrol stations, and utility companies. The result, a conflict thousands of miles away, becomes a financial problem for families across the UK. This is how global turmoil translates into higher bills at home. Inflation means your money buys less as prices rise, and energy is a major driver. When energy costs spike, it affects everything, from farmers running tractors to supermarkets keeping lights on. Each step in the supply chain adds extra cost, making everyday items like bread more expensive. Services feel it too. Taxi fares rise, airline tickets go up, even your hairdresser may charge more. This ripple effect erodes the purchasing power of every pound. For the Bank of England, this is a nightmare. Its job is to keep inflation low, but external shocks like this are hard to control. The bank can't drill for oil or broker peace. It can only use tools like interest rates to manage the fallout. When inflation is imported from abroad, those tools are less effective. The energy shock is a powerful inflationary force, threatening to overwhelm the bank's efforts. This is the essence of the cost of living crisis. Every household feels the squeeze as energy-driven inflation spreads. The bank must act, but its options are limited. That's why Bailey's warning is so urgent. The Bank of England's usual response to rising inflation is to raise interest rates. Higher rates make borrowing more expensive, cooling demand and, in theory, controlling prices. But this time, inflation isn't from a booming economy, it's imported via high energy prices. Raising rates won't lower oil costs, but it will squeeze already stretched household budgets. The bank is cautious, gathering data before its next meeting on April 30th. Is this a temporary spike or a long-term trend? Are people cutting back so much that recession looms? Raising rates too aggressively could tip the economy into recession. The duration of the conflict is key. If high prices persist, the bank may have to act. The danger is inflation becoming embedded. People expect it, demand higher wages, and businesses raise prices, creating a wage price spiral. To prevent this, the bank might have to raise rates, even if it hurts. It's a delicate balancing act. Bailey and his team must walk a tightrope between fighting inflation and protecting growth. The stakes for households and businesses couldn't be higher. The Bank of England isn't alone. Central banks worldwide face similar dilemmas. The IMF has urged caution. don't rush to hike rates in response to the energy shock. This is a supply-side shock, not the usual demand-driven inflation. Raising rates could hurt economic activity without solving the root problem of expensive energy. Bailey agrees, taking the IMF's advice seriously. If rates rise too quickly, families already hit by higher bills could cut spending, risking recession. The global context matters. If other central banks hold steady, the Bank of England has more room to wait. But if others hike rates, pressure mounts for the UK to follow. It's a delicate balancing act, shaped by both domestic and international forces. The bank must weigh every move carefully. The UK's vulnerability comes from its heavy reliance on natural gas. Gas heats most homes and generates much of the country's electricity. When global gas prices rise, UK households and businesses feel a double hit: higher heating and electricity bills. The UK lacks large gas storage, so it buys on volatile spot markets, exposed to daily price swings. The Middle East conflict disrupts global gas flows, pushing prices up everywhere. The UK's dependency on gas is a key risk, making it more exposed than many nations. This crisis highlights the need for more domestic renewables and better energy storage. Reducing reliance on imported gas is now a matter of economic security. Before the latest crisis, the UK economy was showing signs of recovery. The labor market was cooling, wage growth was slowing, and businesses struggled to pass on price hikes. Consumers, squeezed by previous inflation, were pushing back, shopping around, buying less, forcing companies to absorb more costs. These trends suggested inflation was easing, and the bank hoped to hold rates steady. But the new energy shock has changed everything. It's like a late frost threatening the green shoots of recovery. The bank is now back in reactive mode, forced to respond to external shocks. Earlier optimism hasn't vanished, but it's overshadowed by this new threat. The big question: can a cooling domestic economy offset the inflationary heat from abroad? The answer will shape the UK's economic path in the months ahead. Major economic shocks raise a key question: are our banks safe? High energy prices and inflation could stress the financial system, leading to more loan defaults. Governor Bailey says the UK banking system is resilient for now, thanks to tougher regulations and regular stress tests since 2008. Banks have bigger capital buffers and are better prepared for shocks. But this resilience isn't infinite. If the conflict drags on and recession hits, more loans could turn bad, eroding bank strength. The system can handle a short, sharp shock, but a prolonged crisis is another matter. For now, deposits are safe and the financial system is stable. But the Bank of England is watching closely. The duration of the conflict is critical. The longer the turmoil, the greater the risk to financial stability. Vigilance is essential as the situation evolves. What does all this mean for you? Expect higher energy bills. Gas, electricity, and petrol will all cost more. Watch for rising grocery prices. As energy costs ripple through the supply chain, household budgets will be squeezed from multiple directions. If you have a variable rate mortgage or loans, pay attention to interest rate decisions. Your payments could rise. Even fixed-rate deals may be less attractive when you remortgage. Now is the time for caution. Plan your spending, look for savings, and stay informed. The economic situation is uncertain and can change quickly. Bailey's warning isn't panic, it's preparation. Understanding these links helps you make smarter choices for your family in turbulent times.